Economic data out this week shows inflation is slowly easing. This as the Fed paused after 10 consecutive rate hikes. Where do we go from here, and where can investors find opportunity? Joining me now is Research Affiliates founder and chairman Rob Arnott. Rob, thanks so much for joining us from sunny Newport Beach. We appreciate it.
Jack, it's always a pleasure.
So let's start with this fight against inflation. The Federal Reserve's tool, monetary policy, is often described as a blunt instrument, but it's the only one they've got. The irony here, of course, is the Fed is using that tool to beat down a monster largely of its own making.
I think that's exactly right. If you have an organization that has created a tremendous burst of inflation, with 400 PhD economists, more Harvard and MIT together have only 100. The Fed has 400. And those 400 PhD economists can't predict unemployment, can't predict GDP, and can't predict inflation. Now, how do we expect them to manage it effectively? They've created it, and we're tasking them to fix it. There's something wrong with this picture. I look back at Vietnam War was a formative time in my life, and there was a colonel famously quoted as saying we had to destroy the village in order to save it. Is the Fed's goal to destroy the economy in order to save it? I think so. It's very sad.
And so you think there's a real danger that the path they're on will do exactly that?
Yes. One of our advisors is a fellow named Cam Harvey, professor at Duke. He's the fellow who who discovered that yield curve inversion predicts recession. He did it in his PhD dissertation in 1986, and it was later published in the Journal of Financial Economics in 1988. So this dates way back, and his observation is that when you have an inversion in the yield curve, it tends to predict a recession with, so far, 8 out of 8 successful calls with no false positives. That's pretty cool. Now, my own take on it is that the yield curve inversion doesn't predict a recession, it causes one. Because in effect, what you have is the long end of the yield curve set by the invisible hand of the marketplace at the yield level that is appropriate for default risk-free debt, that is an appropriate reward for deferring consumption. Now, if the short-term yield is higher than that, think of yields as a speed bump. If the speed bump is too low, you get reckless driving. If the speed bump is too high, traffic stops. We've swung from a yield level that was too low, propping up zombie companies, leading to malinvestment and misallocation of resources, to now too high. Why doesn't the Fed pay attention to the long end of the yield curve and what it has to tell us about the appropriate level of yields?
So, Rob, I want to switch to your view of where you find opportunities and perhaps dangers in the market. You have a fascinating interactive graph on your website that we can't show on the screen in full because it would just frankly be too confusing. So I cherry-picked a few asset classes I think our viewers might be interested in. Let's start with your prediction of 10-year returns for U.S. large cap and small cap stocks. Why do you get these fairly muted returns?
It's actually very simple. The U.S. is the most expensive major stock market in the world. There's a measure called the Shiller PE ratio, which measures price relative to 10-year average earnings. So that takes out the effects of the economic cycle. You can have an economic peak with peak earnings, and the PE ratio will look artificially lower than it really is. And you can have a trough associated with a recession where the PE ratio is higher than it really is. And so this takes out the effects of the economic cycle. That PE ratio for the US is a little bit above 30 times earnings. That's historically very high. The growth side of the market is priced at an extravagant multiple of the pricing on the value side of the market, about 5 times the valuation multiples of value. So we have distortions in the economy. I think AI, despite its near certainty of massively disrupting the economy in the years ahead, AI has created its own bubble with all of the AI-related stocks priced as if those individual companies are going to be the winners in what's likely to be a vigorous competition over who can dominate in that market. But the U.S. is expensive. U.S. value is sensibly priced, not cheap, but sensibly priced. And international value outside the U.S. is cheap in Europe, in Japan, in emerging markets, very attractively priced. One other observation, inflation is wonderful for value stocks. So if this inflation is not put to death in the coming year, then value is the place to be, not those frothy growth.
Unfortunately, we have to leave it there. I appreciate your observations. You and I have been talking about emerging markets for a long time. I hope your predictions come true because you got some rosy returns there. Thanks for joining the show. Appreciate it.